Don't worry, Bob. We forgive you for being from LA.
Hi, Derek. That's why I moved to New York. I moved to New York to get away of my LA-ness.
Yeah, it's
Yeah.
so different in New York than it is in LA.
Yeah. They straightened me out pretty quickly. I'll say it that way.
We're happy to have you in San Diego.
Thank you, Derek. It's
Yes.
always nice to be here.
Great to have you on. And Robert Brown, how you doing, man?
Good morning, Derek. How are you?
Good.
Pleasure to see
Good
you.
to see you, Rob. So, Rob and Bob today. We're going to talk high-end real estate in San Diego. And it's, the high-end market. What is high-end anymore, by the way? It used to be $1 million. If it was $1 million plus.
I would say that in San Diego, the high-end market really begins at $1 million, but
Yeah.
it's really gone in excess of 2, 3, and 4 million. The way the market's progressed, I've seen a trend towards 2 million plus even in Pacific Beach. And in La Jolla, we've done stuff up to 16 million. So it's gone up into the stratosphere in San Diego.
Yeah. Well, I mean, there's a lot more homes now that are selling for 1.2, 3, 4, 5, 6, even 7. I think Carmel Valley really sort of started that trend of, you want a 4-bedroom house? That's 1.3. And that's still going on, and it goes up to 1.7 or and beyond. So, but we can still say $1 million.
Absolutely.
Is about the marker for
That's
the
about
whole
the beginning of it.
Okay, so let's call $1 million plus high-end real estate. We define that. Now, it used to be the case that the high-end market sort of was the leading indicator for what was happening on the lower end, or what we would call the more normal end. Is that still the case?
I would say that in San Diego, the market started to bifurcate between the east of the 5 properties and the west of the 5 properties. And with respect to the real high-end properties that are over 2 million west of the 5, since they're becoming less and less predicated on the income and underlying fundamentals in the marketplace, they've started to diverge from the underlying indicators and fundamentals. We're starting to see influence from international investment, from people that make money somewhere else and then move to San Diego. So it's kind of separated the ultra high-end market that you'd probably define over 5 million that begins more at 3 million away from the traditional fundamentals of San Diego entry-level luxury.
When you mean fundamentals, meaning like there's nothing you can look at that says, hey, this makes sense?
Well,
It's just sort
I
of
think
arbitrary?
I would say that there certainly are underlying fundamentals: employment, job growth, population growth, or decline. We've had tremendous job growth and population growth in San Diego, but it's no longer predicated and necessitates those underlying fundamentals to go up for those prices to go up, since they're also based on those factors in other places. Internationally, there's a big influence from China, from Canada. People from Europe buy homes here in San Diego now, and as we become that international city, that's bifurcated it further.
How did people in Canada get so much money, Bob?
That's a really good
Who
question.
takes their money all the way up there?
I think it's energy, actually. I
Yeah.
think it's like oil and gas.
Yeah.
That's what I'm thinking.
Yeah,
But
they got a lot of land.
But they have a lot of taxes too, so I don't know where they get. Maybe that's what they're doing is they're getting their money out, and then they can buy it in real estate, so they don't have to pay the taxes. That's just an assumption on my part. So if you want to edit this out later, that's fine.
So Bob worked on Wall Street
Yeah, I did back in the
for
80s.
a long time.
Yeah.
Right? So
Yeah.
every once in a while I throw him a curveball question.
Yeah.
But that isn't too oddball. I'm seriously, I'm genuinely curious, like, how did Canada get all this money? Because some of the biggest markets in luxury real estate are Vancouver, Toronto. Like, what the hell? Seriously, who wants to spend $2, $3, $4 million in Vancouver? No offense. I have some Canadian friends, no offense. But who in the world would want to do that versus spend $2 or $3 million here?
I think that's the influence you see of the international capital that's flowing into the United States and Canada, particularly with respect to these international destination cities like Vancouver and like Toronto. And I think San Diego has started to take its place among those as LA becomes even price prohibitive to the ultra wealthy. It's becoming the beachfront properties there are becoming an enclave for billionaires. And so we're starting to see San Diego take its place as an international city to purchase real estate. And part of that is just because we're a reserve currency and a reserve place to place international capital. And so real estate in the United States, particularly water close and oceanfront real estate, is a traditionally safe asset to place international capital.
And so the thought of that being safe, now, help me with that real quick. So I live in Del Mar, and I walk along the train tracks, and I'm watching the coast just slowly slide into the ocean every day. you know, like, and there's certain places I used to walk where now there's nothing there. It doesn't even exist. Thank goodness didn't happen while I was walking on it. So the coast seems to be going away, and that's what all the geologists tell us, is that, you know, the coast, it's not going to be there forever. But you're telling me that that's considered to be a safe place. Now, I have seen what some of the, down there in the lower areas near Dog Beach in Del Mar, where there's stuff that's like pretty much on the water. I mean, there's guys who literally surfing right by the rocks that protect the foundation of these $10 million, $20 million homes. But people believe that that is safe. So is there no concern about the geological impacts, or do you see some of the higher end buyers considering things like that?
So as an example, I sold a property for $16 million on the oceanfront in La Jolla. And we did a geotechnical survey that said that that property, because it's on bedrock, would be safe for something like 100 years before the residents could even lose 20 or 30 feet. And there it's a half-acre lot, so you had plenty of space. Del Mar is totally different. Del Mar obviously has more issues with erosion and beach erosion. That can kind of be dealt with sand replenishment. It's not the PC thing to talk about in San Diego, but if you look at like who the oceanfront homeowners are in Del Mar, they probably have the political juice to push that can down the road for a long way to come. And with respect to safety, moreover, what I meant was the safety of the US dollar as the international reserve currency. And real estate as a hard asset, an inflation tracking asset, that's a good place to put international currency into a market that's denominated in the US dollar, the reserve
And I knew
currency.
I knew that's what you meant. What I was just trying to say was, like, if, you know, so coastal has always been said, especially like North County coastal. Let's talk, you know, Del Mar or La Jolla, Del Mar, Encinitas. You know, these are, you know, coastal real estate in those areas is very expensive.
Absolutely.
It's very sought after. And a lot of people would tell you that that's the dream. Like, if you could own that and you could do that, you could make that happen, that would be the California dream. There's other places you can go up north towards LA, and you can talk about a lot of different places. Malibu is one of those places that people talk about a lot.
Sure is.
Cebu, you know, like, hey, you can find stuff there, $2, $3, $4, $5 million all day long. A little bit different setup, a little more elevated. But, and so the other reason I brought that up was just curious. You know, I'm always curious when I see stuff like that. There's one for sale right now in Del Mar. It's really close to where I live. It's a $25 million listing. I don't know if you've seen it or not, but
Seen that one.
it's incredible.
Beautiful.
I've not seen a soul there other than the people who work on the place. But it is waterfront. I mean, on the cliff, big lot, really cool. And I'm thinking to myself, I'm looking and I can see kind of the erosion. So I was just asking.
Well, it's
I'm just
interesting if I
curious.
could say, because I grew up in LA and drove along PCH all the time. And those houses that basically you come off the PCH and you park on a deck and the house is on the deck and they're on stilts have been there since, you won't get my age today. But the thing is that they've been there for a long time. And what's interesting, after the big slides up north because of all the rain, there's probably a more immediate impact of the hill on the other side of the PCH, because it's all built on the hill coming down and closing the road or taking out your house, than the ocean doing it at any immediate time. Plus technology, I mean, as Robert knows, you know, that there's the ability to anchor steel I-beams in the hill and pour cement over it to hold the house up. My parents' friends, they've had an I-beam in their house, under their house, 2 I-beams under their house for 50 years in the Pacific Palisades. And the entire bedroom that used to be under dirt is now in the sky, but it's still there. So I'm like, technology. I used to be like, I'm worried about that, but you know, even with earthquakes in LA, in the valley, they're on the cliffs and they have the stilts. And we looked at those back in the 70s. There's no way. They're still there, and they've had serious earthquakes. So it's interesting. You bring up a good point, and at the same time, somehow, and I think everybody also goes, yeah, as long as I'm not in the house, insurance will cover it.
That's a part of it.
It used to be on the ground and now it's in the air, but it's still there.
It's still there. That's
Piece of the oceanfront, piece of the California dream is what everybody wants.
That
Yeah.
view, I mean, and appraisers, they actually add value for that view. Even if you're
Well, definitely.
east of the 5 and you can see whitewater, you're getting $100,000-200,000 bump.
Yeah.
You know, for that view, because you can build a house, but you cannot build a view, as they say.
Yeah, that's true. there's a new term that was coined in the past, I would say maybe 5 or 6 years, the peekaboo view.
Yeah, the
Yeah,
Peekaboo
right.
Ocean View.
The peekaboo view. It's
Stand
kind
on
of
the
a tongue
toilet, look
twister.
through the window.
Yes. You got to climb on the roof, but
It's there.
See it somewhere.
there is a peak, and that is extremely valuable. Now, these properties that we're talking about, for the most part, are waterfront, so it's different. It's a different situation. It's like you don't even see neighbors; you just see water, and there's a tremendous amount of value that people will pay for that. But a lot of the money that we're talking about that's coming internationally, this is big money. Like these are people who are buying a house that's $2 or $3 or $5 million that they're probably going to be in for 10 days of the year.
That's absolutely correct. The majority of the sales that I've done over 10 million or even over 5 million, it's a small percentage of the person's overall net worth. You know, people can have 500 million, billions of dollars, and suddenly the risk factor associated with the erosion isn't as important as their little piece of the California dream that for them is a percentage of 1% of their net worth. But an emotional connection that's much more valuable than that.
Yeah, it's something that, you know, like whoever's going to buy that $25 billion listing in Del Mar, it's probably going to be a CEO, like a Bank of America CEO or something like that. It'll be one of his 12 houses, and he'll probably won't go there very often. But those are sort of the fewer and further between, I think, for the most part, what we're talking about practically in the high end, and the high end that's moving, right? Because a $15 or a $10 million listing could take a year to sell, it could take 2 years to sell.
It could.
But you know, a place that's 1.8, that's a block from the beach, or you know, something like that in Encinitas or Carlsbad or something, that's a hot commodity.
It is hot. Like my specialty is Mission Beach real estate and oceanfront condos in Mission Beach, bayfront houses. Those, if they're priced right, will sell in 30 days. And the typical transaction that my buyers buy, work with one specific investment group that's purchased something like $60 million worth of a waterfront property in 92109 over the last 6 years now. And the typical transaction that we go after, which are the good value deals, you know, we're one of multiple offers, most of them all cash. We're usually all cash, you know, closing in 2 to 3 weeks, depending on what the seller wants. And those will sell very quickly when they're priced to sell.
Yeah, and that's kind of where I think we can learn a little something from the high end.
Absolutely.
Because if that slows down for some reason, that would really tell us something.
That market is definitely more linked to the overall fundamentals, since typically those are investors or second home buyers that aren't in the money is no object space.
Right, yeah, they're qualifying, they're getting financing.
Absolutely.
Yeah, they may be putting a lot down, but they're still, you know, in the game, in the normal real estate game, so to speak. They're not writing
Absolutely.
a check.
And that's part of what you see as the transition of different coastal towns in San Diego as they become more high-end and gentrify, like Mission Beach. When I started there, it was in 2004 when I started selling properties there. I was working with some cash investors from Las Vegas, and it was unique to have that many cash offers on a property. Now, the property's gentrifying in that neighborhood. You've got a big investment in Belmont Park. You see big assemblages happening, you know, from PB Drive all the way up, big hotel project planned there in the future. Now you're starting to see more cash transactions and less financing contingent transactions, which I think is an indicator that the market's going upscale, it's gentrifying, and you're starting to see out-of-state and international investment coming in, even in Mission Beach, where that used to be reserved for Del Mar and La Jolla.
I wonder, you know, when is PB not going to be PB anymore?
Well, you know, it's interesting. I actually, my parents owned a house on the water in Manhattan Beach, and they sold it in 1962 for like $68,000. Yeah, true story. As my wife goes, honey, had you kept the house, we wouldn't have known each other. So my wife is happy. But the point is that it's like, it is probably going there. And what's really interesting too with my Wall Street background is seeing how financing is starting to chase this, because for the last several years, you know, if you want some type of return in bonds, you're going to be getting 1%, you know, 0.5%. And so now what the hedge funds have started to do, and the larger investors they're like, okay, let's set up alternate financing routes for large investments into investment properties or CEOs that need to borrow $1 to $5 million to purchase real estate, and that they're like, we can get 4, 5, 6, 7% interest on these loans, and these people are taking it all day long. So the hedge funds are super happy because they can come in and make 6% versus 0.5% with this money, it's got equity behind it in the property and a down payment. And the person using the financing is super happy too, because then they don't have to put all their money or a larger percentage than the people that are putting the 1% in. But they can divert the $5 million somewhere else into a new business opportunity. So it's really interesting to see how the investment community, the Wall Street guys, have found ways to loan money to people that they have a great CPA and their CPA shows no income. So we can use their bank statements, personal bank statements, business bank statements, or we can explain how they do make a lot of money and they're paid through their S corp, but they have a good CPA, but they're going to put 20 or 30% down on a $5 million house. And some of the investors are like, sure, we'll give you $3.5 million. It's 5.5%, and the people are like, perfect, let's do this. So it's fun to watch how as the economy and the financial system has stabilized, that the Wall Street guys have found ways to make higher interest returns than going into the treasury markets.
Yeah. So
and that financing component's become absolutely crucial, especially with some of the tech entrepreneurs I work with who have revenue from multiple S corps and LLCs, and sometimes one shuts down, another one opens up. Having a skilled lender like Bob to work with, it becomes very important to get them qualified. They can make $1 million or $2 million a year, but having the sophistication in a lender that can look at those entrepreneur tax returns and as LLCs, K1s, and actually make sense of it and get the person qualified to buy their dream house on the beach is crucial to the transaction. So Bob's been great to work with on that stuff.
Yeah. Good luck going to the bank and having them figure that out, right? Yeah.
Well, they'll only tell you that they can't do the loan 4 weeks into escrow.
Yep.
Yeah, that doesn't sit well with, because when you have a high-end buyer buying a high-end property, you also have a high-end seller selling a high-end property. So there's some pretty powerful people involved in that situation. You don't want to be saying you can do things and not being able to do it.
Yeah, you need to deliver. Yeah, totally.
Not going to be good. So do we still believe that the high-end market is the leading indicator?
I would say that the market between 1 and 4 million is probably the leading indicator.
Okay. What would you say, Rob, that it has been telling you in the past 6 months?
So the past 6 months, interesting. There was the slowdown towards the end of 2017, and a lot of us that operate with some velocity and transaction volume in that space were concerned, is this coming into the next recession? But as we come into 2018, it's really started to pick up and heat up. Some of the tax cuts have kind of thrown gasoline on the fire. So I think that's probably pushing that next recession back at least a year or two. And so the question that my investors face today is, will the next bottom be lower or higher than where we're at today in terms of median sales price and the value of the properties they're looking at? Because I don't see that recession, that indicator isn't happening in the next 6 months to a year.
For sure. Yeah, it definitely seems like we've gotten at least a year's worth of reprieve just from the tax cuts. So you're seeing still a sort of a bubbling optimism.
So far, I've seen a bubbling optimism in terms of the data and in terms of the investor sentiment of the groups that I work with.
Because a lot of the people you're talking about, when you say investors, they're buy and hold investors.
Exactly. Absolutely.
They're looking for rental or an income opportunity.
The majority of my investors are high net worth individuals looking for diversification and cash flow in the real estate market. As a portion of their overall investment strategy and portfolio, which will also include, a diversified portfolio of stocks and bonds, commodities, and typically their business. So, the tech guys that I work with, they have their business, they have their stock and bond portfolio, commodities, and then real estate's one portion of that. And they'll obviously ramp up investment like we did in 2010, 11, 12 during what's considered a recession on the way up, and they'll slow it down when they see things heating up, and that hasn't happened yet. We're still seeing acceleration of the real estate investment portion, specifically because like Bob talked about, it's almost impossible to get yield on liquidity in bonds right now. So the 4%, 5% coupon you see in high-end real estate is really attractive to those investors.
We saw yields take another little dip today.
I love when you talk about yields, Bob.
There you go. Yep.
He loves it.
Yes.
The yields
Yield.
They took a little dip today. 10-year did.
Yeah, but rates are going up.
Are they?
Yeah, the rates are going up. We expect the 10-year for sure to go to 3.04 for sure.
Really?
Yeah, but another 15 basis points. It's going there to test it. There's just a lot of pressure on the markets with government deficit spending and the Fed not buying the mortgages and starting to sell some of the mortgages. So rates are definitely going up. But the thing is, and Robert pointed an interesting fact earlier, emotionally people want to own, the dream here in Southern California. And so whether rates are 3.5 or, potentially 30-year fixed mortgages could be at 5% here in the next 6 to 12 months, people are going to still buy real estate. They are, because they're like, I want to own a house.
5% is still very, very low.
It's free money almost, based with tax consequences and things like that, because you're not really paying 5%. You have your tax consequence benefits and things like that. So, yeah, it's still great.
Yeah, definitely. Great stuff. Tremendous conversation, guys. Really great insight. Bob, good to
Always.
see you as always. Rob, thanks for coming
It's a
on.
pleasure.
Man.
Thanks for
Amazing.
having me.
Great insight.
Thank you so much.
Tremendous stuff. All right, you are now officially smarter than ever.